why now? What is it about the U.S. moment compared to the last few years that you think for U.S. multifamily particularly make it a compelling time to enter?
From COVID and lockdowns and interest rate plunging and interest rates spiking and development being spurned through low interest rates and all this stuff, we've come out the other end today with a very unique opportunity where the multifamily space for us is an extremely attractive entry point in terms of new investment.
The U.S. has 40 major metros that have over 2 million people in them, and that gives people a lot of choice, and it gives companies and multinationals also a lot of choice.
Let's get started. Sasha, Peter, thanks for coming out to the first episode of Boardroom Brief for 2026.
Glad to be here.
It's a new environment.
New environment, yeah. You like the new digs?
I do.
Yeah. I mean, 2026 has only briefly started, but we're well on our way into the year. Okay, so as we sit here today, Canada's real estate market is turning a corner, right? Rates have eased, something we've all been sort of hoping for. Development pipeline is recalibrating, and transaction volumes haven't fully recovered. But with that being said, it seems like Canada is prepping itself for a new cycle, one defined by stability and growth. In the U.S., we're hearing a different story. Multifamily investment spiked late last year. Pricing has stabilized, and new starts and deliveries have dropped sharply in the multifamily market. Combine that with cap rates that are making it a welcoming environment for new buyers, especially long-term ones, right? And I think for Greybrook, that lines up well. We've been investing in U.S. for over 10 years, building out infrastructure, operational capabilities, asset management capabilities. And I think a lot of that is to prepare ourselves for moments like this, to move in when opportunities present themselves. So I want to start there. You know, given the current environment, Greybrook is now going to be expanding presence, expanding our holdings in the marketplace. We're going to be launching our upcoming U.S. Multifamily Income Growth Fund. So Peter, I think the question for a lot of our investors, a lot of the people sort of watching and listening to this is, why now? What is it about the U.S. moment compared to the last few years that you think for U.S. multifamily particularly make it a compelling time to enter?
Sure. It's interesting because there's been a number of black swan events over the last 5 years. There's been a lot of once in a lifetime that's happened a few times over the last 5 years, but through those things come opportunity.
Yeah.
And those convergence of different events from COVID and lockdowns and interest rate plunging and interest rates spiking and development being spurned through low interest rates and all this stuff, we've come out the other end today with a very unique opportunity where the multifamily space for us is an extremely attractive entry point in terms of new investment, and I'll tell you why.
Okay.
So cap rates have been the most expanded in terms of this marketplace they've seen in the last 10 plus years. So for an entry point, while that has to do with interest rates, obviously, we think it's very attractive. Two, the low interest rate environment spurned a lot of new development. Now, while probably not in the exact garden style stuff that we're looking for in terms of price point, it did have supply entry into the market. Those have either finished or about to be finished, and new starts, not unlike Canada, for various economic reasons, have been extremely limited. So you have an expansion of cap rates, you have a very limited new supply of theoretical rental stock, even if it's not a direct competitor to what we're doing, and you're seeing that these vacancies are stabilized and rents are growing. So when you couple all those things, to be able to come in and start acquiring these assets, as you said, the spike in activity at the end of last year, I don't think we're unique in our thinking, but the ability to come in and acquire as much of these assets now at these attractive values to ride what we think is going to be positive trends is something that's very attractive to us.
Yeah, I mean, it's very compelling because even if you look at sort of the recent numbers that have come out, just from a deliveries perspective, it's about a year-over-year 25% drop in new deliveries in the multifamily. So yeah, clearly sort of that wave of new construction is now starting to dissipate. In 26, all the forecasts are saying 26 will be the same thing. Sasha, so we've been there for 10 years, right? We've been in the U.S. market for 10 years. Clearly, we've learned a lot. Talk to me a bit about some of the lessons that we've learned over the last decade or so of having already had a presence in that marketplace.
Well, I guess in 10 years, given everything Peter just said with regard to what happened in a 10-year time frame, that black swan events, as they call them, I guess the opposite would be a white swan. Whatever.
Those are common.
They became white swans,
yeah.
and they were everywhere. And there was kind of pitfalls everywhere. So you could have been anywhere for 10 years and got 30 years worth of lessons.
Mm-hmm.
So I guess on the one hand, having to navigate through some generational challenges in the real estate market, particularly as it relates to the economic consequences of COVID and the rapid volatility in interest rate and everything that came with it. I think having projects at different points in the development cycle really forced you to have to exercise your muscles in terms of being able to deal with those challenges. And when we talk to our team, a lot of times when you're going through the challenge, you can't see the silver lining. But the silver lining is, it's like when your kid does stuff and you say that, well, they're going to learn what if they fall off their bike, they're going to learn, right? Like I think that in a lot of ways, we had to just learn a lot on the fly, and I think we did a relatively good job. So I think on the one hand, the event-driven learning and everything you had to do to react, to try to be proactive, to try to be almost as much ahead of the curve as possible, seeing issues that might come up and having to kind of forecast that and get ahead of it. So there's a number of those things. But I think on the non-event driven side, when we first started investing in the U.S., our experience was only in Canada. Mm-hmm. And I think we learned very quickly the enormous differences between the two countries. Now, markets are all different and have different characteristics, but as it relates to residential real estate, one of the biggest things we learned is how different demographic patterns and migration trends and the dynamic between supply and demand are in most major U.S. markets relative to Canada. In Canada, we have this giant supply gap. We talk about it all the time. Migration trends and immigration trends tend to push people into our major metros, of which there are only 2 or 3.
Sure.
So for that reason, the demand side is compounding and the supply side can never keep up. The U.S., on the other hand, has 40 major metros that have over 2 million people in them. And that gives people a lot of choice. Mm-hmm. And it gives companies and multinationals also a lot of choice. So the dispersion of employment opportunities is much greater than it is in Canada. And therefore, migration trends are much different, the way people move around cities. And I say this all the time when I'm talking, in Canada, having somebody that's born in Toronto, goes to school in Hamilton, and comes and lives in Mississauga is semi-exotic. Whereas,
well-traveled.
Right. But when I lived in the U.S., like 8 out of 10 people I met were like born in Ohio, went to school in Massachusetts, and now live in New Jersey. Yeah, right. So very common. And that's partially driven by selection, right? 40 major cities, and then also partially by the employment opportunity. So why does that all matter? What we learned, and it sort of dovetails into what Peter was saying as to why we think, this particular strategy is very deliberate and why we're pursuing it now, is because we learned that amidst all the volatility that we saw in the world, we saw very stable rents and we saw very stable occupancies in the multifamily space. Mm-hmm. Simply put, people need shelter.
Sure.
Particularly in the Class B and those kind of vintages that were maybe less luxury focused or less high-end focused, for sure.
Yeah, so in a challenging environment, those types of products just have a defensive stability profile.
Sure.
And we really thought that was a great thing to buy in any market, right? Whether this entry point or otherwise, we like the defensive characteristics of it. And then when you combine that with kind of what's happened leading to a specific opportunity in a window that we think is attractive from an entry point, like it made it a bit of a no-brainer as to why now.
Yeah, I mean, in sort of as you talk out loud and knowing Greybrook's positions in some of these markets, right? So, I mean, across the 10 years, we've got chips on the board across the Sun Belt, right? We're in Houston, we're in Atlanta, we have multiple holdings in Florida as well. So I feel like we've learned a ton through those 10 years to understand, hey, which markets, speak to our thesis. And now that we're, really going to be expanding those holdings, can you just touch on in sort of the most concise way that you can, what is the general thesis at a high level for the fund?
Yeah, so we can tackle this one together. I think from my vantage point, we're at a period of time, given what's just happened, that is going to change some of the migration patterns that I just talked about, right? And we do have a presence in the in the Sun Belt, and what we are looking at is markets that, like, what's the key theme right now?
Sure.
Affordability.
Yeah.
Right. Affordability is a big challenge in Canada. Affordability is a big challenge in America. People are talking about, inflation being tapered down, and what we're talking about in the data is that the rate of change is back under control, right? Back to 2% or 2.5% or whatever that number is. But if you look at a basket of goods pre-pandemic in America to a basket of goods today, it's 20 to 30% higher, right? So that
50,
doesn't go
70% higher.
well, depending on what, but like on a broad basket, right? So if you think about that doesn't go backwards.
Sure.
So that strains people's overall affordability, and as it relates to incomes, they haven't kept up at the same pace. So what that's doing is it's creating a lot of strain. What is one of the most important things, if not the most important thing, is housing, shelter.
Yeah.
So people are starting to have to look to more affordable markets. So part of what our thesis is, and I'll let Peter touch on replacement cost and why that's relevant to the pool of these assets, but from a demand side perspective, we're looking at more affordable markets where the rent to income ratio is sub 25% or 20%, right? Whereas you look at some major cities in the US, it could be 30 or 40% of after-tax income. So it's moving people from a demand side into these markets. And because there's a finite supply of this type of product, you have a growing demand amidst a finite supply. And what will that do overall to rent growth? What will that overall do to the desirability and demand for these assets? We can do the math on that.
Sure.
Yeah, I mean, I look at it pretty simply. They can't make any more of the type of multifamily assets that we're doing because the cost to deliver them, you could never charge the type of rents that is in existence. So there's a limited supply of that. Whether more people, there's 340 million people in the U.S., whether more people are getting jumped into that class of housing, or there's already not enough for the demand, and they can't make any more of it at this price point. And it's quite simple. With the expansion of the cap rates and the ability to have agency debt like Fannie or Freddie debt, where we'll cap out at a maximum leverage of 65%, there's a positive spread between the cap rates we can buy these assets at and the rate that we're going to borrow at, which can create a yield. And most of the time when people want to get yield, so we're looking at the 5.5% yield range, they have to sacrifice growth, because you can't get that kind of yield and get growth. Forget about tax efficiencies and capital gains and all that other stuff. So today, you don't have to do that. You have an asset pool that you can buy. You can leverage it to a responsible max leverage of 65%. You can get agency debt, create a yield, and then also get 10, 12% in total return because of the rent growth that we're seeing, because of ability to increase NOI through operating efficiencies, through turns of different stuff like that, with a little bit limited more external capex and all those things, and maintaining high occupancies. So we're looking for properties that have a history of high occupancy, that have limited deferred maintenance, and all those things will simply add up to a nice yield and a nice total return. And the tailwinds that we talked about that are theoretical, whether it's interest rates coming down, cap rate compression, little supply tapering off further, increase. Those are tailwinds that aren't part of the calculation,
that's bonus,
right? So today, it's very easy for us to do that. We operate, we have 4,500 apartments that we manage in our portfolio today across Canada and the U.S. We operate these assets. We're very familiar with these geographies that we're investing in. And frankly, we think that the time literally could be better.
Yeah, and you mentioned geographies, and I think what Sasha said was really interesting too, because I think a lot of Canadians may not realize how transient the American individual is, right? Unless you kind of know Americans or spend a lot of time down there. It is very, very common, even from my own sort of anecdotal personal experience. So given that we're already in some markets, given that we're sort of targeting a specific type of thesis, Peter, touch on like what specific geographies are we going after? You know, multifamily also is a very broad word. Like what kind of multifamily are we going after?
Yeah, so in terms of the kind of product, it would typically be garden-style stuff, either ground-related townhouses, maybe a couple, 3 stories along those lines. You know, communities that might have clubhouses and pools and things that you think about traditionally. We'll call them Class B assets that aren't maybe totally brand new, but would either have been made in the 90s or earlier, so it could be early 2000s or something like that. We're not buying 60s, 70s, and 80s vintage for a few reasons. One, those properties typically have more deferred CapEx requirements, which it's harder to keep occupancy as high. The cost of doing that is a little bit of a deeper value add strategy, which we've done successfully.
Sure.
But blending income and growth, we like to keep the occupancies higher. So that's the product type. And the geographies is Sun Belt and Midwest. And whether it's Houston and Dallas and Atlanta and the Carolina, you know, Raleigh or Durham or, you know, many places in Ohio, the Midwest tends to be quite stable. The Sun Belt has most stability and a little more growth. So when you mix those things in there, you can really achieve a great, traditional yield with the upside of growth.
Sure. And sorry, go ahead, Sasha.
No, and I was just going to add to that, like, new for us is the vehicle that we're choosing, right? Having an open-ended fund, and we'll probably touch on that a bit later. But just to Peter's point, like one of the things that is different when you're doing that gives you more flexibility is the ability to manage to that income and growth in a different way, right? So you can choose markets on an aggregate basis, and sometimes you're making investments that are much more for the stability profile. When it gets to a level of maturity where, you know, there's a cash buffer there and all that kind of thing, then you can choose different growth markets. So doing that and giving our investors exposure on a broad, diversified basis to not only diversification across markets, but diversification across the asset type, notwithstanding we're sticking to kind of garden-style properties, but the specific nature of those properties, I think, is really well achieved through an open-ended vehicle like this. And it gives you a flexibility that we sometimes don't have when we're capitalizing something on an individual basis.
It gives us more tools in the toolbox to manage to a total return. And for example, if one of our properties is showing an ability to generate higher rents through more turns and a higher value add program, that might mean that property will sacrifice occupancy because, you know, you're turning stuff, you're moving stuff, construction's going on. Well, we could have other parts of our portfolio where we do less of those value adds, increase the occupancies to balance out the portfolio. If you have one property, you have limited tools in your toolbox to ebb and flow as the market changes, and things, I don't know if you've noticed, but they could change over, from year to year in some kind of drastic ways. So doing that allows us to have a lot more tools in our toolbox. And obviously the open-ended nature and the liquidity nature of it, which I'm sure we'll talk about, has been quite attractive for people.
Yeah, I think the vehicle, I think, is key here, right? The flexibility of, you now have multiple levers, right? Do you pull the rent growth lever? Do you pull the value add lever? You know, do you pull, like, you know, Sasha even touched on flexibility. Eventually, when you have enough stability, are you going after Class A properties? Are you maybe entering new markets you haven't explored before? I think the vehicle is paramount here in that ability. So with that being said, and Sasha, I'll ask you this, it sounds like, you know, and correct me if I'm wrong, this isn't about like a single property or a single I have a very strong conviction in this one particular thing. This is about building a U.S. platform.
Yeah, I think that's right. Also, by nature of this product type. So like if you think about development and the requirement to have a lot more local context, not saying you don't have to have local context here, but it's really a lot about sort of macroeconomic drivers and understanding kind of the migration trends, supply demand of the actual asset type. Whereas development is like rules-based, right? Zoning and all that kind of thing. So it gives you a lot more broader access to markets because you're looking at these markets on a very macro level first and foremost, and then it gets down to the asset specific thing. So, you know, we've had a platform in the US for 10 years.
Sure.
This is about expanding our platform in America, and I think that to your point, it's not a isolated strategy. I mean, this is the strategy that we think is the most timely at this point in time, and it's durable. So
Sure.
just like we've seen over the course of COVID and everything that we talked about, stability in this asset type, this is not a fair weather strategy. It's a durable strategy. So, what happens thereafter and how we build on that, we have a commitment to that market. Not Canada's always been our core market, and we continue to be bullish on Canada. And there's going to be a time where it makes a lot of sense, including like right now, to be buying things in Canada. But the U.S., notwithstanding what is happening geopolitically, what's happening sort of on the max uncertainty front, it's still the most liquid, deepest market. If you look at capital inflows from around the world, notwithstanding everybody's got their pitchforks out saying how much they hate some of the things the U.S. are doing.
Sure.
Then they put their then they put their pitchfork down and they write a check into something in the U.S. or into the S&P 500 or into one of the AI companies. Like, the level of investment and the level of capital flow into the United States is unmatched anywhere in the world. So that's just a market that you need to have significant exposure to, and that's what we believe, and that's why we kind of want to continue to expand our platform.
Yeah, the data.
Yeah, I mean, I think people tend to think about, like, the outside investor tends to think, oh, the investment opportunity that we're talking about today is the thing that you're doing today. We've got 140 professionals under one roof. We are doing a lot of things simultaneously, all at the same time, divided by teams and divisions and organizations and infrastructure and all those things. So we are out there today feverishly looking for, let's say, development properties in the greater Golden Horseshoe area that make financial sense. There's still a gap between sellers and us as a buyer. It doesn't mean that we're not searching under every rock to find something, and we will find something.
Sure.
And our team that is involved in it is doing that. Simultaneously, our value add that we exist is going on. Simultaneously, our apartments in Montreal are going on. This has been a strategy that we've been working on for the last 12 months. It's not been a 1 month or what, in terms of the vehicle. Obviously, we've been in this market for a number of years. So it's not new. It's not different. It's not a shift of focus. We continue to move all boats forward, including our active developments that we own. Some of our condo sites that are there's not a big robust condo market today. So we're looking at retirement. We are looking at end user geared stuff for the right geographic locations. We're looking at purpose-built rental, which in some cases are harder than others. So there's a lot going on, and I think that it's important for people to know that if we're launching a new fund vehicle in a platform that already exists and operating, it's not a shift of focus. It's not a new thing. It's everyone's moving all the other things forward simultaneously.
Yeah, and I mean, on that note, again, for our audience and our investor base, a significant portion of our holdings are Canadian holdings, right? And Canada and Southern Ontario has experienced a difficult sort of time. What's your outlook over the next 12 to 18 months on the market as a whole here domestically?
Yeah, I do believe that there is going to come a time sooner rather than later where the actual need for housing will meet the uncertainties that exist in the market. I don't believe that people aren't buying, let's say, low-rise homes because rates are too high. While rates may or may not nominally come down, the rates are not the issue today.
Sure, yeah.
It's the consumer confidence of uncertainty between jobs, tariffs, economy. What can I sell my house for? And we've seen it before. The longer real demand stays on the sideline, it is building. And it has to start in the low-rise side of the market first. And the reason I say that is because if people have confidence in being able to sell property, or they're buying a property that's not going to, the value is going to go up from here, there's going to be a lot of people who haven't moved over the last number of years who want to either get in the market, life circumstances, move up buyers, move down buyers, you name it. So I think that we need to see, they have to feel as if something bad isn't going to happen tomorrow. Now, when is that going to be the case? Hard to tell.
Sure.
Sometimes the news cycles come quick and fast, and they go away sometimes quick and fast. We're going to tariff this and not that, the Bank of Canada, rates might go. Okay, so I think that we need to have some stability for people to do that. Whether it happens in a quarter or 4 quarters or 6 quarters, it's hard to say. And then on the low-rise side, on the high-rise side, I do believe that structurally the government is going to have to do something on their side of the cost equation. Hard costs are coming down. They're not able to come down so much that it bridges a gap that exists today. It's going to have to come from the government somehow giving in to that. I just saw a headline, and I should have probably read it when I saw it yesterday. The city of Mississauga eliminated development charges for purpose-built rental.
Yeah, for PBRs. Yeah, I saw that.
You know, you have a conversation about the city of Toronto. They say, well, we can't get rid of development charges. We're going to have a deficit. Most people know this, but municipalities like Toronto can't issue bonds or debt like they do in the U.S. municipalities, right? So they have to balance the budget. They've taken it out of the reserves. And their answer is, well, we need that. We can't keep taking. It's like using your RSP to pay for groceries.
Yeah.
Like, that's a problem, right? So they're saying, well, we can't afford. Well, you know, pick a development charge and multiply it times 0.
Yeah.
We can all get our calculators out, get your old TI-83 out, and it's still 0, right? So they have to help meet that. And then, like, that's going to take some time, but I think it's going to organize itself. And the supply drop-off that is existing both in the U.S. and the multifamily side is happening here in condo. Like, what I will tell you is whether it's 12 or 18 or 24 months from now, the rents that have been moderating across the GTA are going to spike. Because while we've had all these completions, there's going to be a very limited amount of completions.
Yeah.
And there's a real demand for this stuff. And you're going to see a real spike in rents in due course.
Yeah, it's going to be a true dry spell.
And so I agree with everything you said. And I just want to draw people's attention to, like, we saw the other side of this exact human psychology. Where people have recency bias, right? So they're like living in today's moment, thinking it can never get better, and you know it's only down from here, and all that kind of thing. And you're just hearing negative, and that manifests with the way the market is not functioning. That consumer confidence. Like, rewind back to when COVID happened, right? And we talked about this at the time. You saw an unnatural spike in the price of things because people were feeling extremely confident, right? Notwithstanding what was happening physically in the world with the pandemic, interest rates were 0, right?
Yeah.
You had government commitments saying they're going to be 0 for a long time. Don't worry about it. By the way, you still have your job. You don't have to go anywhere. You can't spend any money, right? So savings are going up. The stock market's ripping. Bitcoin's at $2 trillion, like whatever, right? Like,
you can't spend money because you can't go anywhere.
Yeah. People were buying NFTs and metaverse. Like, it was insane.
Guilty.
But
we have a nice plot of land in the metaverse.
The point I'm trying to illustrate is, in a moment of max confidence within the consumer, you saw prices spike the other way.
Sure.
Now, it's not a good thing either way. Like, we people in our industry, people that invest, just want certainty and stability. Like, we're not looking for the big swings, right? But I'm just making the point to illustrate how crucial confidence is in the equation. It works both ways. So as Peter pointed out, I think that once the market starts to get unstuck, that is a need-driven, demand-driven thing, and people start gaining the confidence in transactions, confidence in, if I put in $1, it's going to be worth $1.10, not worth 85 cents. Now all of a sudden you start seeing a very, very different dynamic in the market.
You know what people almost never talk about is the lead up into COVID. So they just think, oh, COVID, supply, all the things you just said, that was the driving factor. There was a multiplier effect that I think, while hard to quantify, I think it's material. In 15 and 16 and 17, the low-rise market was ripping here in Toronto again. Yeah. And then when B20 happened in spring of 2017, it was like the same thing. It's never going to get better. Everyone just went to the sidelines. And then you had that demand building through the end of 17, 18. And it wasn't until mid or fall of 19 when the market started having a pulse again. I remember we launched Richmond Hill. We started selling. And then like 4 months later, COVID happened.
Sure.
But like you had a 1.5 year spell. Obviously, COVID, poured gasoline on the fire, if not, more, whatever. But you had that pent-up demand that didn't happen the end of 17 and 18 and in the first part of 19. You have that today, except for a longer period of time. Hopefully, you don't have something that pours gasoline on the fire and it can grow in some kind of measured pace, because like Sasha said, you want steady growth rather than these spikes of whatever. But that was a big factor That is happening now. How it's going to manifest itself into the market, I'm not exactly sure. That's a real thing.
And you have to look over time. Okay, so and I think Peter just made a good point by like looking. We're focused on COVID, right? He's like, well, what about the 5 years before COVID? So like, I think it's super crucial, and I'll give you a great example. And this is why, as I sit here today, I'm not going to speak for him, but as he sits here today, I'm confident. Mm-hmm. I'm not worried about it. And people look at it and they're like, how come you're not worried? I'm like, well, because, and I'll tell you why. Here's a good example. During COVID, the amount of podcasts I did or interviews where people were like, okay, so now that cities are over, and now that nobody's going to live in, work in an office building ever again, what do we do, right? And at that time, it's like, okay, that doesn't sound like that's probably likely for the future, but regardless, we dealt with that, and it was a cycle. Today, I read an article that, CIBC built two brand spanking new office towers in the downtown core, fully leased. In 2021, had you told somebody that, listen, these things, humans still interact, humans still need places to live, humans still need places to work, you're going to start seeing it's going to manifest differently, and it might take some time, but these things throughout the course of history have shown they cycle, and they cycle because of human nature and human psychology and the economics behind it. So it's just another example of how, as we sit here today, we can't put a finger on whether that is a 12-month or 18-month or 24-month time frame, but we can look at all of the prerequisites and know that as they start coming down one by one, we're getting to a different place of stability, and that makes us confident to buy in Canada. And it might not be easy to do.
No, yeah, but it's funny because you tie that back to our U.S. multifamily garden style strategy for a second. Nobody at any point in time through all the craziness thought that's useless. No one's going to want. Forget about the reality of cities, not formations changing, and infrastructure and all the things, social being, all the things that we believe and obviously is maintained. But while occupancies might have fluctuated in terms of like people moving, leaving, whatever, nobody ever thought, well, we don't need that anymore, or that's not going to be a thing. And that drives the stability of that market. And that's part of why if you can couple it with a great entry point in terms of cap rates and prices and replacement costs, and couple that with supply shortages, and hopefully couple that with, let's say, stable interest rates, forget about decreasing interest rates. These are all tailwinds and all things that why the entry point now, it's not by chance. It's not, you don't want to do something in Canada, so you're doing something here. We're happy to do nothing if nothing makes sense.
Sure.
We've proven that. And for us, this is a real unique opportunity. And of all that's happened in the U.S., this opportunity has manifested itself, and we want to take advantage of it.
But the thing he said right there about, how at that point in time, nobody thought that this stuff, wasn't required or whatever, that's not even anecdotal. Like, we owned a lot of it.
Sure.
Right? So, it's an important thing to understand. This might be a new strategy, but this is not new to us.
Yeah.
We've been investing in multifamily since 2018.
New vehicle, not the strategy.
New vehicle. But, so we lived it. Like, during COVID, where there were shelter-in-place things, and we had a value-add program where the strategy was to turn units. Mm-hmm. But we had stable occupancies. We were collecting rent. Like, all of the things that people thought, this is not... In this segment of required housing, it just we had that stability. So we lived it ourselves. Like, it wasn't one of these things where I read it in a report, or I think this is what happened, or it's some history. Like, we had a portfolio of thousands of units that we saw this happen. So we've seen it stress tested in these very volatile, strange kind of environments.
So let me play devil's advocate for a second then. Let's talk about the other side of the coin from a risk perspective. Where do you see risk factors potentially emerging, and how are we sort of dodging and weaving on that front?
Yeah, so I think the best way to answer that is to say, what could affect returns?
Sure.
Because there's a few different ways to looking at it. If you believe that the values of these assets are going to continue to deteriorate from a cap rate perspective, that could have an effect on your total return of, let's say, the 10 to 12% that we're targeting. Given we own these assets and they'd be financed, they wouldn't necessarily have an effect on your yield or your monthly distributions.
Sure.
So let's start that those cap rate expansions could affect total return. will not affect distributions. Typically have 5-year debt that we take on. So when we buy something, it's fixed debt for 5 years. We've got a long runway. We're paying down the principal in most cases, and there's a positive spread.
And a low LTV, which matters.
Yes, for sure. There's a maximum LTV of 65% when we buy something. So that can affect your total return. Is that a risk factor? Is that not like, you can decide what that actually means. Can you maintain occupancies? Well, these things have been around since, for somewhere between 10 and 30 years, depending on when we buy something. Long track record of occupancy and need and all those things. So we do believe that people will continue to live in the places where they've lived for 10 to 30 years. But if occupancy drops, that could have an effect on both distributions and total return.
Yeah.
But you can, it's not going to be empty. So even if you had to drop your rents,
Sure.
instead of being 92% occupied, I could have less rents and be 98% occupied and offset the need for the lower rents and then still maintain distribution. So these are one of the levers that we're talking about. Also why the diversification of multiple jurisdictions. If something happens in Oklahoma City because the Thunder's championship parade tore through this, whatever.
They have a Hamilton native anchoring that team.
Yeah, right. So that's part of the beauty of the multiple properties and all those things. So can we execute a value add strategy on budget if we spend way too much money and aren't driving the rents? Well, two things. One, we can because we're doing it all the time in many different areas. But also, we could just not do the value add strategy in terms of the turns for a specific property if it doesn't make financial sense and focus on rent growth, operational efficiencies, adding revenue streams. Like, in Montreal, we built in-suite laundry as an example. That was an upgrade if possible. You charge, $50, $100 a month more for rents. So there's so many different things that can augment that strategy. And then from a financing standpoint, that would typically be a very important thing to know in the U.S. Because we're focusing on agency debt, we're not going to Bank of America. We're not going to Goldman Sachs. We're not going to different things. We're not going to hedge fund lenders. We're not trying. This is a popular strategy in the U.S. Variable debt, 2-year durations, high IRRs, low multiple on capital strategy where you'd come in, you'd turn it, and you'd get out. That can work, and it did for a period of time until it really didn't work. So eliminating the high LTV, eliminating the variable debt manages some of those risks. But, I talk about development all the time. If you did it with a guy in a truck who didn't know anything and had no relationships, and he's building a building, we're building a building, to the average person, they may not see the difference.
Yeah.
But some of these guys were 90% levered at variable debt with limited capital access and all those things. So the short answer is, of course, there's risk factors that are involved, but our ability to maintain and hold and how we're financing it, we're doing our best to juggle and be able to manage those things. And while they can have an effect if things really change, we think the overall risk profile in terms of stability, distributions, and growth, especially at this entry point, it helps avoid some of the higher risk. If we were coming in, if we had launched this strategy in 2021, that's an example, which we actually didn't buy any value add to the 21. Part of the reason was we looked at cap rates and said, I'm buying something for the lowest cap rate by a country mile ever. Less attractive for us, right?
If I can just frame the question a little differently, the risk question, or frame my answer a little different, because I do think it's important. Like, there's risk in every investment, other than like a T-bill or whatever, right? Like whatever you would consider.
In theory, because the risk in a T-bill when the government shuts down.
But whatever you would consider the risk-free investment.
Okay.
Now, what's the problem with the risk-free investment? The problem with the risk-free investment is, it's paying me 4% a year, except if inflation's 3 or 5 or whatever, then my net return is actually maybe less. It's less than 0, right? In some cases. So then we look at the spectrum of risk, right? So what's the other end of the spectrum? Venture capital, right?
Sure.
Alex has an idea. Okay, well, there's a lot between an idea.
I'm in, Alex.
There's a lot between an idea. I'm confident you could do it, but there's a lot between an idea and a billion-dollar company, right? So that's an immense amount of risk, and you should be compensated for that. So where does multifamily sit in that spectrum? Not judged by Sasha. That judged by the world and every investor. Okay, so it sits marginally higher than the Treasury bill. in terms of a rate of return that an investor expects to get. So when we're talking about cap rates, well, what is that? Okay, so Treasury bill is 4.2 or whatever it is, and the cap rate is 5. That means that somebody is expecting 80 basis points more to hold that residential asset than they would holding a risk-free asset.
Completely passive too. Yeah.
Why?
Yeah.
Why? Because it paces with inflation, because of all the things we've talked about in terms of the stability profile, defensive, people need a roof over their head, finite supply, demand growing, all the things we talked about. We lived through COVID, we saw the volatility, full. So for those reasons, there's a modest premium. And so overall, everything Peter said about the risk that we're managing and how we're managing is right, but the world is judging for you. So we think that based on this entry point, there's a unique ability with a tailwind behind you that you don't need, right? So if none of that tailwind transpired, you'd have a stable yield, you'd have a moderate growth profile. That's a good trade-off from a risk-reward perspective. Now, if we're right about that tailwind and the timing and all the things we talked about, you should see a little more juice in that return. And that's why we think the time right now is very unique and very timely.
And I think it's very important to both touching on risk and also so people understand the difference between 5.5%, 6.5% return in terms of a cap rate, some positive spread with the debt or whatever. The difference between that and the 10 to 12 that we believe we can deliver is our active management of the asset. It's not a passive. If I bought that asset and did nothing, I'm not going to probably get 10 to 12%. But if I can optimize the NOI, so if you're talking about, quote unquote risk profiles, the risk is the execution of the NOI growth to create the difference between the 5 or 6% yield that you're getting paid to the 10 or 12% return that we expect. And we believe we can deliver that from a combination of rent growth, optimization of NOI, some value add, and different strategies.
Yeah, no, absolutely. I'll ask you guys to kind of end with this, and I know I kind of throw out these curveballs at the end of these episodes.
I've never known you to do that.
So and this will be a defining highlight, is I want you to define or summarize what 2026 will be in one sentence.
Well, why do I go first?
You got to go first.
I have more experience with your curveball.
Has he ever answered a question in one sentence? Thank God we're taking
That's actually what went through my head is like one sentence. How am I supposed to do that?
We're going to cut it in post. You got one sentence.
I'm most excited about 2026 versus any year in the past 5 because of the change that we're seeing that is very tangible in the markets that we operate in.
Okay, I'll take it.
I don't know if that was that great.
No, that's good.
On the spot.
Average at best. I mean, maybe even a run-on sentence if you really want
There's
to
some
think about it.
commas, semicolons.
syllables.
Yeah, I think 2026 is going to be a transitional and transformational year, both for Canadian real estate and the U.S. multifamily space.
Guy tells me I had a run-on sentence.
Well, I mean, I had the opportunity to prepare my answer, so I'll say, my answer is it'll be a year defined by discipline, patience, and positioning. And I think positioning being the key one there, because if I summarize everything we've talked about today, is we are positioned to take a step into the U.S. market at a very opportune time. And as investors, which we all are, and as an institution we are, you have to be proactive versus reactive to sort of look in the rearview mirror and be like, oh yeah, in 2026 we could have acquired all this great multifamily if only we had known. So I thank you both very much for being here today. I just want to shout out that on the next episode we'll be sitting down with Carl Brady, who is the president of Greybrook Multifamily, to really dig into this fund, dig into the specifics. So to our audience, please make sure you join us. Until next time.
Thanks, Alex.
Thank you.